Welcome to the second webinar in the series related to inviting proposal for Industry University Cooperative Research Center on Terrorism and Cyber Insurance Modeling and Underwriting Challenge, being brought to you by the American Academy of Actuaries, the Academy, the Federal Insurance Office, FIO, and the National Science Foundation, NSF. Thank you for joining us today. I'm Wanchin Chou, Chair of the American Academy of Actuaries Committee on Cyber Risk. As we start this session, note that I, along with Mohan Kumar, Program Director of NSF, and Steven Seitz, FIO Director, will be setting the stage with opening remarks prior to introducing our panel. With us today for the panel, we have Senior Insurance Regulatory Policy Analyst Chanda Brady as the moderator, and 5 outstanding panelists from the industry with expertise in terrorism and cyber insurance modeling and underwriting, who will share with us the best practice and discuss the challenge in the industry. The panelists are Derek Brown, Senior Director from Moody's RMS, Crystal Park, Head of U.S. Cyber Analytics from Aon, Mauricio Gobeto, Head of Cyber Catastrophe Modeling from Guidewire Sign, John Lux, Vice President of Analytics from CyberCube, Scott Swensky, Head of Marsh McLenn's Cyber Risk Intelligence Center. Listen, learn, and please ask questions during the webinar. But first, some housekeeping. Information about this webinar slides. Our comments are our own and not made on behalf of the Academy, our employers, or any other organizations. The Academy operates under applicable law, and Academy volunteers annually acknowledge its conflict of interest policy. Also, the program is being recorded and will release publicly within a few days of this webinar. The event is now open to the news media. Comment and question must abide by federal antitrust and other applicable laws. Maximize your viewing and engagement experience. I would like to point out a few tools on your screen that can maximize your viewing and engagement experience. The individual windows are resizable and movable, so please feel free to move them around to get the most out of your desktop space. You may expand your slide areas and the media player by clicking on the arrow in the top right corner of these windows. After the prepared remark and discussion in terrorism, cyber insurance modeling, and underwriting challenges, there will be time for questions and answers. So please, if you have any question for our panelists, you can submit them through the Q&A engagement tool. Note that your question will only be seen by the panelists, but not by other attendees. We invite you to share your input on today's webinar and your idea for future Academy by clicking on the text survey tool on your screen. Last, please mute yourself to avoid any background noise unless you are talking. There are 2 goals for the webinar today. Continue educating all of us on the cyber insurance modeling and underwriting challenge involved. Help prepare both academic and insurance industry partners to submit proposal to the NSF to create an IUCRC. We'd really like to express appreciation to the NSF for their creation of IUCRCs. Our continued work with them on climate risk IUCRCs began last year is the basis for our very high hope for the success of these IUCRCs focused on terrorism and catastrophe cyber insurance. We also like to express appreciation to the FIO Director Steven Seitz and his team for all the work to help the insurance industry face emerging challenges and for the many interactions with the Academy in which FIO inform our members and our members provide input on behalf of the actuarial profession. For those participants who do not know, the American Academy of Actuaries is a DC-based 20,000-member professional association whose mission is to serve the public and the U.S. actuarial profession. The Academy assists policymakers on all levels by providing leadership, objective expertise, and actuarial advice on risk and financial security issues. The Academy also sets qualification, practice, and professional standards for actuaries with credentials, mostly from the Casualty Actuarial Society and Society of Actuarial Organization in the United States. The Academy's own work on cyber risk has helped to focus on some of the issues we will be discussing in this webinar. Our cyber toolkit, consisting of cyber threat landscape, silent cyber, cyber data, cyber risk accumulation, cyber risk reinsurance issue, ransomware, war, cyber terrorism and cyber insurance, autonomous vehicle and cyber risk, personal cyber and cyber risk resource guide, etc. In addition to the research paper and educational topic, the committee is also discussing the cyber database governance and cyber modeling. Please check out the cyber risk toolkit on the Academy website and let us know if you have any question. Our research project on cyber risk in partnership with Professor Marie Kreiss of ESSEC in Paris focus on the challenge of modeling the extreme value of cyber risk in a practical way. Listen, learn, and please ask questions. With that, I would like to introduce NSF Program Director Mohan Kumar to talk about the value of the IUCRC program. Mohan, please.
Thank you, Dr. Chou. This is Mohan Kumar from the National Science Foundation. It is my pleasure to be here. I welcome you all for this webinar and panel. So actually, a week ago, we had a webinar where we described the industry university cooperative research centers at the NSF in more detail. Today, you can always look at that webinar. That webinar is available online. You can take a look at that. Today, I will give a very brief overview of what IUCRC is about. IUCRCs are centers that are supported by the National Science Foundation for more than 50 years. At the moment, there are about 70 IUCRCs in areas spanning engineering, computing, and geosciences. And they also are spanning across about 200 universities across the US. An IUCRC is a platform supported by three pillars: the NSF, university, and industry. So the university professors have conversations with industry colleagues to understand what are the research problems industry is facing in a particular area, and what challenges they are facing to address these problems within their industries, and then create projects around these problems. So that is the hallmark of an IUCRC. In particular, IUCRCs are about pre-competitive research. That is, industry colleagues do not do not compete with each other, but they share research problems and challenges, and they work together with university professors and students to address problems of national interest. So that is how an IUCRC is created. Typically, to create an IUCRC, university researchers have hundreds of conversations with industry colleagues to understand the problems. And today is one such opportunity to hear from industry colleagues about what kind of problems the industry is facing. So I request the university colleagues to listen to the panel, listen to panelists from industry, and then start thinking about what research problems are of interest to create an IUCRC in this area. So I will stop here. Thank you.
And then so
thank you, Mohan.
Okay.
Yep, sure. Thank you, Wanchin, and thank you, Mohan. This is Steven Seitz, the Director of the Federal Insurance Office. And first, we'd just like to echo the comments from earlier and really thank the National Science Foundation for their partnership on this initiative. This is the first time that the U.S. Treasury Department has partnered with NSF. We're very excited about the potential and ongoing collaboration. And also would really like to thank you, Wanchin, for all of your work, and we appreciate the Academy hosting today's webinar, and it's helping to support the important work of this IUCRC. As most of you on the call know, the Federal Insurance Office monitors all aspects of the insurance industry, including terrorism and cyber insurance issues. This newly initiated IUCRC is an extension of our work administering the Terrorism Risk Insurance Program, and it's also related to FIO's ongoing evaluation of a potential federal insurance response to catastrophic cyber risk. The Terrorism Risk Insurance Program is a public-private partnership that was formed in the wake of the devastating September 11th attacks to ensure that the insurance industry can continue to underwrite the risk of terrorism despite a potential market failure if the U.S. would suffer another large-scale terrorist attack. And although the U.S. has been fortunate to not experience a certified act of terrorism since the program was created in 2002, the program's place in the market has ensured that terrorism risk insurance under commercial property and casualty policies has remained available and affordable. The benefits and value of TRIP has been affirmed numerous times by Congress in multiple reauthorizations, with the program now reauthorized through 2027. And TRIP has helped to foster economic growth that depends, in part, on whether commercial property, employees, and operations are insured against the risk of terrorism. As many of you know, through our administration of the program, FIO collects terrorism risk insurance data and conducts analytical reporting. We've also published guidance and rules about TRIP's mission to stabilize terrorism risk insurance markets. Our team at FIO has also been focused on cyber insurance in lines of insurance eligible for coverage under TRIP. A cyber attack could be certified by Treasury as an act of terrorism if it meets the TRIP program requirements. And in recent years, FIO has increased its collection of data on cyber insurance. This is an important area of work of our ACRSM as well, and also as our team looks at the intersection and nexus of terrorism and cyber. In addition, in June of 2022, the Government Accountability Office directed FIO to conduct a joint assessment with DHS's Cybersecurity and Infrastructure Security Agency to determine the extent to which risk to critical infrastructure from catastrophic cyber incidents and potential financial exposures warrant a federal insurance response. This direction was reiterated by the White House last year, the National Cybersecurity Strategy and its implementation plan. In partnership with our colleagues at CISA and the Office of the National Cyber Director, FIO is currently in the second phase of our assessment, which is exploring the appropriate form that a federal insurance response to catastrophic cyber incidents might take. We've worked with industry and the public on this assessment through a variety of mechanisms, including a Federal Register notice seeking requests for information from the public published in September of 2022. FIO has also held 2 stakeholder conferences. The first was held in November last year and was hosted jointly with our colleagues from the New York University Stern School of Business. I think that was a great example of the benefits of the public-private partnership and academic collaboration. Our second conference was held a few months ago at Treasury in May. In responses to our RFI, these conferences, as well as our other ongoing engagements with the insurance industry, have played a vital role in taking our work forward. Since our inception at FIO, we have worked closely with the insurance industry stakeholders to understand issues in the market and fulfill our mission. For example, FIO facilitates the Federal Advisory Committee on Insurance, which is a group of industry stakeholders that provides advice and recommendation to assist FIO in carrying out its duties and authorities. We also have the Advisory Committee on Risk Sharing Mechanisms, or ACRSM, which provides advice and recommendations to FIO regarding our administration of TRIP, and also the importance of the creation and development of non-governmental private risk-sharing mechanisms for protection against losses arising from acts of terrorism. As you can see, industry, government, and academia dialogue has been invaluable to our work at FIO. And with the initiation of this new IUCRC on terrorism and catastrophic cyber modeling and underwriting, we are very happy to bring academia more into these discussions and conversations about solutions to insurance industry issues, particularly those related to the risk of terrorism and catastrophic cyber. As Mohan mentioned, this IUCRC is a collaboration designed to maximize resources and cross-disciplinary expertise among government, academia, and industry in pursuit of the IUCRC's objectives, which include, first, helping insurers to estimate risk with greater certainty, thereby improving insurance pricing, coverage, and policyholder uptake. Second, contributing to the potential expansion of reinsurance and capital markets to help support these risks. And third, informing the treatment of terrorism and catastrophic cyber risk in government programs. By combining the investments, expertise, and creativity of the academic community, industry, and government, we hope to discover innovative approaches that will help accelerate improvements to terrorism and catastrophic cyber risk modeling and underwriting, with the main goal of strengthening the resilience of the U.S. financial system for the benefit of the American people. We hope that today's panel discussion helps you better understand some of the challenges around modeling and underwriting for terrorism and catastrophic cyber risk. And most importantly, we hope that sparks your insight and interest into areas that would benefit from further academic research and analysis. I would like to thank all of our panelists today for their time and engagement with our team, and also for their willingness to share their expertise with all of you, and in particular, the academic community research we have. Finally, thank you again to our FIO team, in particular Chanda, for all their continued efforts to ensure that this IUCRC is a success. We appreciate all of your interest in this important endeavor, and we look forward to the ongoing engagement as we address the threat of terrorist attacks and catastrophic cyber incidents. Please feel free to reach out to anyone on the FIO or NSF teams with questions, and thank you again for being here. And Wanchin, thank you for organizing, and I hope that everyone enjoys the panel. Thank you.
Thank you. Thank you so much, Stephen. And thank you for the great open remark. And as Stephen and Mohan indicate, this is a great session. So we hope you can listen, learn, and ask questions during the webinar or after. Chanda, floor is yours. Please go ahead and have the open discussion with our panelists. Thank you.
Thank you, Wanchin, and thank you, Stephen. Hopefully everyone can hear me. If you can't, please say so in the Q&A. But I'm Chanda Brady, a senior policy analyst with Federal Insurance Office, and I'll be today's panel moderator. We're going to begin our panel discussion by talking about the unique aspects of terrorism modeling and underwriting. Then we'll switch over to cyber, after which we'll highlight a few general points applicable to both topics. We're hoping to save about 10 or 15 minutes at the end for Q&A. But first, I'm going to have our panelists introduce themselves, starting with Derek.
Thank you, Chanda. I'm Derek Blum, Senior Director of Product Management at Moody's. I've got over 20 years of catastrophe modeling experience, including both cyber and terrorism. and I sit on FIO's advisory committee for risk sharing mechanisms.
All right, Crystal. Crystal, we can't hear you.
Can you hear me now?
Yes.
Okay, sorry about that. Hi everyone, my name is Crystal Bach. I lead US Cyber Analytics for Aon Reinsurance Solutions. I'm an actuary by background, but my team does a mix of actuarial and catastrophe modeling now. And I've been at Aon for about 6 years.
Thank you. Maurizio?
Yep. Good morning, everybody. Thanks a lot for inviting me to this webinar. I'm Maurizio Gobbato. I'm the head of catastrophe cyber risk modeling at Guidewire Science, leading a team of data scientists, data engineers, modelers, and actuaries. I have about 12 years of experience in catastrophe modeling, spanning from NatCat, natural catastrophe, cyber risk modeling, and terrorism risk modeling.
Thank you. Don?
Hey everybody, John Laux here. I'm the Vice President of Analytics with CyberCube. We're a data analytics modeling firm specifically focused on cyber risk. I'm an actuary by background. Our team does risk quantification, modeling, actuarial work, as well as cyber risk expertise. We think it's really important to bring those things together when doing this work. Similar to some on the panel, I've been in the industry for close to 20 years, most of my career at a large reinsurance broker before joining CyberCube. Thanks.
All right, and Scott.
Hi, I'm Scott Stransky from the Marsh McLennan Cyber Risk Intelligence Center. I've been also in the risk modeling world for about 17 years, quite some time. Focused on cyber, though, for the past 11 years. My team builds our own cyber models from scratch, which we'll talk a bit about here. We also license a lot of third-party data sources to help complement the things that we build. And we do a lot of work with universities already, so we'll talk about how that fits in here.
All right, thank you, everyone. Let's begin. Derek, can you explain some of the unique aspects of terrorism that have to be factored into how the risk is assessed and modeled?
Sure. Well, terrorism modeling for the insurance industry really emerged after 9/11 attacks, particularly in the US. And in the process, it established terrorism as a catastrophic risk and also led to a lot of innovations, such as driving the market's focus on exposure accumulation management. And the sort of terrorism risk modeled in the US is a very low frequency but high severity kind of risk, so extreme events. And unlike most of the CAT models that existed before it, terrorism is a man-made catastrophe, which has a number of unique aspects. So first, the overall event frequency can't simply be estimated just by looking at past events. This doesn't mean we can't assess frequency, but it does mean we need to use other methods to do so. And it's important to recognize that terrorism risk is heavily dependent on counterterrorism measures and law enforcement. And because of this, we're effectively modeling the risk of failure of prevention. And using game theory and some other methods, we can actually derive a frequency distribution, which is what we do in our model. Another unique aspect of terrorism is that event frequency is non-Poissonian. So what this means is that events aren't random or independent. You can imagine in the aftermath of a terrorist attack, security is at a very high level of alert, and the likelihood of a second or third event is considerably lower based on the response. Another difference is that distinguishes terrorism from, say, cyber risk is really the necessity to be physically present. Traditional terrorism involves various weapons, or what we might call attack modes, and these range from conventional bombs to more extreme things like chemical, biological, radiological, or nuclear attacks. And successfully carrying out a terrorist attack requires people, planning, and materials. And so the more complex the attack, the less likely it is to be successful, either because the terrorist group is interdicted and disrupted, or because of failure of execution. So we have to think about that and really the likelihood of success. And fourth, and really the last point I'll make for now, is that the likely universe of scenarios theoretically is infinite. A terrorist could attack any target, any physical location, but practically this really isn't likely. terrorists do have an agenda and motivations and goals that include being noticed, causing lots of physical or financial damage and loss of life. And so we have to study terrorist organizations to better understand their preferences for targeting, the motivations, and their capabilities. And so this allows us to construct a finite but reasonably complete set of attack scenarios that can be modeled. And then we then use a variety of methods such as computational fluid dynamics, particulate dispersal, and other things to assess the consequences when such attacks occur. So that's in a nutshell, kind of the modeling process and some of the things that make it unique. And let me hand it over to Maurizio, who I think might have some thoughts as well.
Yeah, if I may add a couple of comments on that, I would echo very much what Derek just said on the motivation side. Terrorism risk is really prioritizing the ideological goals of these terrorist groups, as opposed to cyber, where most of the attacks are financially motivated, and there is a whole bunch of downstream processes that are helping industries to get up into business, like starting from ransomware negotiations and the remediation services. So there is a whole bunch of peculiarities of terrorism that are really unique. Derek mentioned about the non-Poissonian distribution of the events. The likelihood of having multiplicity or multiple attacks against the same target, or even against the same countries in a given year, are decreasing in likelihood due to the counter measures that are put in place by law enforcement. That's not true for cyber in most of the cases. If you think about a cyber criminal, if they're able to extort money from a given company exploiting a certain vulnerability, they more likely do it or keep doing the same thing on and over again. So there are aspects that are unique. The other aspect that I would like to put an emphasis on is the large potential for contingent business interruption losses due to cyber. So you might have an attack against what we define a single point of failure. In this case, would be a physical single point of failure that can trickle down CBI losses, contingent business interruption losses, across multiple line of business downstreams.
Thank you. All right, turning back to Derek again, can you talk about what kinds of data terrorism risk insurers and modelers use?
Of course. As with any model, data is going to play a really critical role in terrorism risk assessment. And so we need to differentiate between the data that's needed to construct or build the model, and then the exposure data that defines what we're analyzing. So really the model inputs. And both pieces of both sets of data are really critical. So let's start with model data for terrorism. So we gather information about different terrorist groups. We gather information about past terrorist attacks that have occurred on a global basis. In many cases, there isn't enough event history within a particular region to base the risk solely off of what is happening there. So we look globally at what is happening to learn about different kinds of practices and attack methods. We want to understand, for example, when attacks occur, do they show trends in terms of increasing frequency, increasing severity, or decreasing severity? Do they show a propensity for attacking certain kinds of targets or certain locations? And of course, there's a lot of data that is used to capture the relationship between what we call hazard and vulnerability in modeling lingo. For example, suppose we want to model an attack like a 5-ton bomb at a target such as the Empire State Building. Well, the model tells us what the footprint of that attack will look like, specifically things like the blast pressure and other effects at various distances. And we can then translate that hazard into damage rates and the impacts on not just structures, but human populations as well. And so we want to be able to consider the exposure that's overlaid on top of that. And so there's really a ton of data that goes into developing hazard footprints and vulnerability curves. And I won't get into all the specifics there. That would be a whole other presentation. But let's shift to talking about exposure data. And this is the term we use to define, in this case, an insurance portfolio or a collection of risks that we want to analyze. But it could really apply to just any collection of physical properties or people in the case of terrorism. So as modelers, a role that we play is to help determine what the most critical exposure elements are that should be captured and fed into the model. And we have to balance that ideal set of inputs with the data that the insurance industry readily has access to, the data that we can supplement or enrich, and any assumptions that need to be made in the absence of that data. And so for terrorism, the most critical bits of exposure data are the location, such as the lat long, the construction class, what buildings are made of, the building height, and then attributes such as the property values or the number of people at a particular location. And there's other attributes and inputs as well, but these are the most critical. And as basic as those seem, it wasn't and isn't always easy for companies to capture that level of data. So one of the things that terrorism risk modeling really advanced significantly was capturing very high resolution data down to a street address or lat long. It really highlighted the importance for capturing very granular information for something that can have such a concentrated level of risk in a small geographic area. And there's another class of data that relates to things like intelligence, although this data is really highly classified and not readily available for modeling. So it's not information that we have special access to, but clearly it's part of the overall picture for understanding terrorism risk and counterterrorism measures that would go into that.
All right, thank you. For our final terrorism-specific question, I'd like to have Derek and then Maurizio discuss the areas of terrorism modeling and underwriting they think need additional research. And Derek, we'll turn to you again.
All right, thank you. Well, let me start just by highlighting some active terrorism research collaboration that Moody's is involved with in conjunction with Professor Neil Johnson of George Washington University. So Professor Johnson is a leading academic researcher on quantitative terrorism risk. And we've been collaborating, one of our staff members, Gordon Wu, has been collaborating on a paper entitled Generalized Shock Formulation Unifies Israel-Palestinian Violence. And this paper explains how the October 7th attack force could assemble so easily, yet be missed by Israel's surveillance activities. So this just highlights that there's really a lot of room for better understanding the nature of risk, the manner in which it kind of emerges, the nature by which a lot of activity is very hidden up until the point that we see the manifestation of that terrorism or violence in the absence of interdiction. And so I think understanding the geopolitical developments all around the world that really may be driving risk here in the United States, but also elsewhere. We aren't necessarily just looking at risk as it exists within a particular geographic area, because there's a lot of interconnectivity between all of this. And so a couple other thoughts that I think are areas that could benefit from research through the IUCRC. One is, that terrorism forms a subset of events that really belong to a larger class of risks that we can think of as political violence. And the scale of terrorism or political violence can range pretty significantly, although the insurance industry really tends to worry most about either the really large events or high-frequency events that really pose a solvency risk in the aggregate. And so recently we've seen a growing trend for this violence to manifest in sizable and costly riots. Notably, there were the 2019 riots in Chile, which caused over $3 billion of property damage. There were the 2020 George Floyd protests, around the country that collectively cause between $1 and $2 billion of insured loss. And although frequent, mass shootings are also a concern, but they haven't really led to massive industry losses. But what could be interesting here is to better understand and do some research into the dynamics of civil unrest and whether we can predict the time, the location, or severity, or whether there are metrics or tipping points that can prove useful for modeling and estimating when and where these sorts of things might happen. It's really something that isn't modeled much today, but in the current climate, I could see how this would become very useful. Another possible area of research is how private industry can play a role in prevention. So for the most part, the insurance industry's goal is about resilience. It views really the prevention and mitigation of terrorism risk largely as the domain of the government, the intelligence, and law enforcement communities. But maybe individual businesses or people can play a bigger role in the actual prevention. Maybe AI can be leveraged in some way. And with political tensions at really high levels, there might be tools that can help mitigate the radicalization and violence that we see that appears to be increasing. So perhaps the research can help identify things sooner and avoid any future acts of terrorism, whether they're foreign or domestic. So there's just a couple ideas. There are clearly a lot more areas of research that could be done. And Maurizio, I think you might have a couple as well.
Yeah, if I can maybe add a little bit more color, definitely I want to emphasize one more time what Derek just said, more on the frequency side. He talked about political unrest, riots. It would be really interesting to see if some academic level research can prove that these are worth modeling, risk worth modeling. Are they going to impact the AAL more than what we do today in terrorism risk modeling? AAL stands for average annual loss. And overall, they can provide more transparency and confidence in the way we develop the hazard module of this type of risk. On the severity side, I would maybe add the fact that there is potential to do some additional research on downstream effects, as I mentioned earlier, of terrorist attacks. Imagine if there is a terrorist attack against critical infrastructure that can cause further downstream damage, not only in terms of business interruption, but also in terms of damage. What if that single point of failure of critical infrastructure is a dam, for example? What would be the actual overall economic damage? Then on the other side, more on the CBI again, on the downtime, if we think about what happened on the World Trade Center, the implications downstream, not only for the surrounding businesses, but businesses that are dependent through supply chain or through some sort of precautionary measures that are taken down or halted. What would be the overall impact in terms of downtime at that point? These are aspects that are not fully yet developed in both terrorism and cyber risk modeling, I would say. So the potential there is really large.
All right, thank you, Maurizio, and thank you, Derek. Let's switch over to cyber now. Recognizing that this is a hotly debated topic, this IUCRC is meant to focus on catastrophic cyber risk. How would you approach a definition for that term? And Crystal, let's start with you.
Sure, thanks. So for me, the biggest difference between catastrophic cyber risk and attritional or large cyber losses is that catastrophic cyber risk involves an attack that spreads to affect multiple companies in an automated way. So for instance, there's a threat actor attack on a single point of failure, and many companies are affected downstream from that attack without the threat actor needing to complete any additional steps to affect those companies. Attritional or large losses, on the other hand, are typically targeted events. So the threat actor is specifically trying to infiltrate the network of a particular company. There are some events that cause confusion around this. So for instance, an attack on a single point of failure may lead to a vulnerability that threat actors can then utilize to affect multiple companies. But if it requires secondary impacts, typically I would not view that as a CAT event. That would be non-CAT, which would fall into either that attritional or large loss category. There are some companies that have a financial loss definition included in their CAT definition as well. On the reinsurance wording side, which is where I sit, typically that's not part of the wording, which is really more of a function, I think, of the contracts that we're looking at. So an attachment point is typically high enough where that's not really a factor. But I will just caveat, I think internally there are some financial loss definitions associated, differentiating CAT and non-CAT as well. The other big difference between how we look at attritional and large losses, which all fall into that non-CAT category compared to catastrophe, is how the two are modeled. So we do have enough relevant data typically around attritional and large losses to use traditional actuarial methods to estimate those losses. However, with the cyber CAT events, of course, we have not seen many of those yet. And even after seeing more, we likely will still need to use vendor models or realistic disaster scenarios to model those. This is very consistent with how this is done on the property CAT side as well. So typically CAT losses are estimated with a model and non-CAT would be with actuarial methods. So it's very similar on the cyber side.
All right. Scott, do you want to jump in?
Yeah, I mean, Crystal basically gave the relatively well-accepted definition for CAT versus attritional. I will say that my view, and I think the view of many in the insurance world, is that we have not really seen a major cyber CAT event yet. We've seen some events that are close or right on the edge of being CAT events. For example, NotPetya back in 2017 barely meets the definition of a CAT. Some would say it's right on the edge, some would put it over the edge, some not. I would say we haven't seen the game-changing event for cyber CAT yet. And this creates some challenges when we think about modeling. When we're modeling natural disasters, we have a lot of CAT events, whether it's earthquakes or hurricanes or floods or fires, whatever it is. There's a lot of CAT events you could look back on in history. But on the cyber side, because we have not seen that major CAT event, there is a lot of speculation going on. So people speculate, oh, it could be a major cloud that fails. It could be a power outage. There's a lot of things that people postulate. But our perspective is that it's really going to lead to one of a few different consequences. And I think the consequences are more important than what actually gets you to that consequence when you think of it from a high level. For example, it's either going to lead to data being lost or stolen, like credit card records or medical records or things like that. It could lead to downtime, business interruption loss. It could lead to an extortion payment. There's a finite set of things that can be an outcome, but there's an almost unlimited use your imagination, creativity type of exercise to figure out how you get there. I think that's much harder than figuring out, okay, here are the finite set of outcomes. So when we think about a CAT event, it's probably going to lead to one of those three or maybe a few other types of downtime, records lost, or extortion payment outcomes.
All right, thank you. Now that we have that context, John, can you explain how CAT cyber risk is modeled? And then we'll have our other cyber modelers, Mauricio and Derek, weigh in on that too.
Yeah, sure. So maybe trying to use some of the same language as we use for terrorism. So the exposure part, I think, is the first thing to wrap our heads around. So I'll get to what Scott just said, because I think that's an important place to go. But yeah, the primary question to start with, if we're talking about catastrophic risk, is how can cyber risk aggregate? We know the world's increasingly reliant on technology. Several panelists have already used the term that we use, single point of failure. So certain technologies that have a very wide footprint, a very wide adoption, are the means often by which that potential aggregation can exist. And I would distinguish, we think about those, if you hear me use the term SPOF, that's single point of failure as an acronym. Some of those can be ends in themselves, the cloud service provider, for example. Some of them can be means to ends, a software or an operating system, for example, that sits very distributed across different networks, for example, can be a means to an end in that regard. A couple recent examples we've seen of those kinds of events, Change Healthcare, the big provider earlier this year that's part of United, and a more recent example, CDK, which is an automotive technology provider that affected about 15,000 different organizations in the US. And so these are all different technologies. So the first thing to help grapple with aggregation for cyber as opposed to a targeted incident or a traditional incident would be, how do we identify the potential accumulation or dependency between company A and technology B? The most desirable way to do that where possible is to use what we call technographic data to establish some kind of dependency. And there's different ways you can do that with a variety of data sets, data collection techniques, web scraping, those kinds of things. That's useful for certain things. It's not useful for everything. So it's always important to be able to fall back on, kind of adoption rates and market shares, or some way of kind of estimating, kind of the space that you don't see, to kind of infer the dependency between those things. That's really the core to the exposure aspect of how the models come together. And then obviously we need to build modeling around that. So, an event set that looks at a wide array of permutations, estimating frequency, then we have this exposure, this what we call the footprint aspect of it, and then severity downstream of that to kind of translate that through to costs. I would say there's kind of two important aspects when we kind of think about how the models come together. The exposure is the first one, and the second one is the hazard axis, if you will. And as Scott said, from an insurance point of view, it's not maybe so relevant where the attack comes from, although we believe that's really important to kind of get a sense for how broad the potential footprint of the event could be. But what are the actual kind of impacts that flow out? So you can kind of imagine a grid of those different possibilities that can play out. I think one of the things, and we'll get into this a little bit, but as Scott said, the insurance world is very specific in terms of the kind of costs that are covered. So the potential economic damage from a cyber attack could be very broad, especially if you kind of get into secondary, tertiary impacts. The insurance impacts tend to be more specifically scripted and focused, and that does focus where the impacts go. And while privacy is a concern, I would say just generally that's something the insurance world has gotten fairly comfortable with. It tends to be more of those what we might call first-party impacts, the extortion, the business interruption, the data corruption or destruction. Those kinds of things tend to be more the costs that are concerning to insurers. So I'll pause there, Maurizio, and I think maybe others wanted to jump into. Sure. Yeah, I strongly agree with everything that all the previous panelists said, and especially the fact of the definition of single point of failure. Like, it's not only a physical entity like an AWS data center, let's say. For us, a single point of failure could be a software vulnerability on an operating system, let's say, that is widely distributed across multiple servers, across multiple companies. In the way we model catastrophic cyber risk, though, is there are some nuances that we need to take into account. And that's one thing maybe I would like to add here. When you have this type of widespread malware, automated distribution, as was mentioned earlier, one difficulty from the attacker point of view is how do you make a profit out of that? How do you collect ransom? Imagine you are impacting 100,000 companies. How are you going after that and negotiating the ransom payment? So that's one drawback potentially from an attacker point of view of this type of events, and that's something that we are trying to factor in. It seems that these criminals are trying to find some sort of sweet spot where they can impact one company that has multiple downstream implications. John mentioned Change Healthcare earlier, like a single company recently acquired 130,000 companies downstreams or that could have been potentially impacted. They paid ransom pretty much right away. So high profitability with minimal negotiation or efforts to try to collect that ransom. So there is a little bit of this, call it game theory, call it profitability margin, if you want to, that we need to factor in the way we model these type of events. And that's where we could benefit a lot from additional research. The other aspect, again, on the downstream, maybe it's only purely digital. Change Healthcare is an example. What about if it goes from digital to physical and then impact the physical supply chain downstream? We know some clients are thinking about that from our end. So that's also another potential point of research that can be explored. And
Derek, if you want to add more to that, please go ahead.
Yeah, I mean, a lot of great comments were made by John and Maurizio. So I'll just add a couple of things. For starters, I think the way we model anything is really to understand the nature of what it is. So we start for cyber by really looking at understanding the threat itself and what are the mechanisms by which a cyber attack could occur, right? Are we talking about data theft, malware, or ransomware, cloud outage or outage of critical systems, business email compromise, DDoS attacks against financial banking systems. And also, each of those is almost like its own model in terms of understanding who's doing it, why they're doing it, what the mechanics are for successful attacks of those different natures. And also what rises to the level of being catastrophic. Is it that there's lots of claims in the aggregate? Is it that individual companies have really significant losses? You can reach that level of kind of catastrophic cyber risk in a number of different ways. And so we want to really understand the breadth of each of these attacks and different magnitudes. And I also want to comment briefly on this issue about kind of technographic data or single points of failure. So one of the challenges is just that technology is changing all the time. Cyber is a very dynamic risk, in large part because the technology is very rapidly changing. And it's nice to know, it'd be nice to know all the technology used by every company out there. But this may not be very practical, at least not as practical today as hopefully it will be in the future. But we have to think about in our line of work, for insurers, they may not have access to this information about the digital supply chain. And even when it can be identified for some companies, it might lack indication of materiality or criticality to the business. Just because they use one technology doesn't mean that they're exposed. It may not actually be a critical part of their business. So we have to think about, the importance of that, how much you rely on it, and also what do you do in the absence of that data? And in some cases, you might need to rely on other factors to proxy risk in order to quantify it. So, for example, our model, it looks at the company's attributes itself, not just technographic or firmographic information, but like the size and the sector and the location of a company. These also can be really useful in assessing risk.
Thanks, Derek. Scott, can you talk about the kinds of data the cyber insurance industry uses?
Yeah, absolutely. So I'm reminded actually of a few different quotes that I've heard. One of the quotes that I heard in my previous job, I think it really is very true here. And what it is it says, great data plus a good model is better than good data plus a great model. Meaning the data is actually more important than the underlying model. And I think that is very true. And I'll talk a bit about the data here. The other quote that comes to mind, basically at any modeling panel, I have to say this quote, but it's a quote from the very famous statistician, George Bach. And he said that all models are wrong, but some are useful. So I think that also goes to play. Like the model's going to be wrong, but if you feed the best possible data into it, you'll get something that's very useful for our clients, for the industry, for the government, for the stakeholders that care. But as far as the data sources that we need to use when we're thinking about cyber modeling, it fundamentally starts with what we call firmographics. The firmographics are what Derek was just talking about, the basics about a company, its industry, its revenue, number of employees, where it is geographically around the world, which you may think from a cyber perspective, like, why do we care about geography? It matters a lot when you think about regulations, potential fines, GDPR regulations in Europe. All of these things matter a lot from a geographic perspective. That really is the most fundamental data we use. And you can build a trivial cyber model that just uses revenue and industry as predictors, and you'll get a decent result. It's not going to be as good as the models that the folks in this call are building and use, but you can get a very good first estimate of just industry and revenue. From there, you need to understand data on historical incidents. And there are a bunch of different ways you can get this type of data. You can get it by doing web scraping, which was mentioned earlier. Looking at news articles, you can do Freedom of Information Act requests to each of the state and territorial governments. There's a lot of ways to get public views of this data. But in our mind, it's quite biased. And you really need to supplement this publicly sourced data with proprietary data. And that usually comes from the insurance industry. The insurance industry is actually the best place to look, in our view, for unbiased cyber breach and incident data sets. If you look at public data, if you don't have to report it, there's no incentive to report it. People are not going to report it. On the other hand, if you have a cyber insurance policy that you've been paying for, you're actually going to want to report it to your insurance carrier, to your broker, to others in the value chain. And therefore, for the smaller set of companies that have purchased cyber insurance, we actually have a very, very good understanding of who does or does not suffer cyber incidents. So that's a really fundamental part of our data, is looking at that proprietary cyber insurance loss data. From there, it goes to technographics. So I know technographics have been brought up before in this conversation, but here we're looking at cyber-specific predictors and things. This could be things like single points of failure, SPOT, which was brought up earlier. It can be things like ratings, outside-in ratings, where people are studying a company's network from the outside and coming up with a score that then is potentially is the keyword, predictive of cyber incidents. It could also be inside-out technographics. And this is a bit more of a challenge, but for example, at Marsh, we have something called our cyber self-assessment, where we ask our clients to fill out hundreds of questions about themselves internally. These are things that you wouldn't be able to see from the outside, but we found that many of them are actually quite useful and quite correlated with cyber insurance losses. A more modern technique is inside-out data automatically. This, of course, requires a company's permission, and then you can install some sort of a software package or hardware package within a company's network, again, with their permission, to collect telemetry data from inside their network. You probably have seen car insurance commercials on TV where you do telemetrics and give you a discount on car insurance. Like if you're not slamming hard on your brakes, they'll give you a discount on car insurance. The same thing is starting to be the case for cyber. We've seen some insurance companies offering actual discounts in cyber insurance for installing these telemetric systems within a company. So there's a lot of different types of data that we can use when we're building these models. And as I said, to kind of start this little discussion, the data is really fundamental. You can build a wonderful model, but if you feed it with bad data, you're not going to get great results out.
Thanks, Scott. And I think John wants to weigh in on this one too.
Yeah, just one thing I would add. It's come up in a couple different settings or points that were made earlier in the panel about maybe the relative absence of historical significant catastrophic incidents for cyber, and that's kind of been it's a deterrent. Maybe it's a good thing for society, but it makes our job more challenging. One of the things I'm a big believer in is working to extract as much knowledge or information as possible from the incidents we do see. One of the techniques that we found very useful for doing that is what's called counterfactual analysis. And this is something that's existed in this kind of space, and it's been used in terrorism modeling and other things for some time. We tended to find it actually could be quite well used for cyber, because when you look at how a cyber attack plays out, there's different frameworks for doing things. One of the ones that we like to use, I think a lot of the industry uses, is the Lockheed Martin kill chain. So the step-by-step process that a threat actor goes through to carry out impacts on a particular target, where they're successful, where they're not, where they could have, pursued a different target or had a different kind of impact than what actually happened, can be a very useful way to structure your thinking around attacks that we haven't seen but almost saw, for example. So a good example of where that could be very relevant, the SolarWinds attack, which happened late in 2020, was an incident where, the ultimate impact from an insured loss point of view was very, very minimal. It was pretty much just the SolarWinds network, but the threat actors in question were spying on government agencies and defense contractors working in the United States. They had very deep and persistent privileged access into those networks. And one of the questions that we've been, I think, grappling with as an industry is, what if those threat actors had decided to do something more destructive for a variety of reasons, just to maybe create some smokescreen on their way out or purposefully to cause disruption? So that's, I think, a useful technique and a way to bridge some of the limitations in that historical data that Scott was talking about.
Thanks, John. Crystal, can you discuss cyber insurance policy exclusions, including the reasoning behind their exclusion?
Absolutely. So typically 3 major things are excluded from cyber policies. One of those being cyber war, critical infrastructure, and then physical damage caused by a cyber attack. And one of the big reasons that these perils are excluded is that it's really difficult to model these types of events. So what does a cyber war really look like? That would be a very hard question to answer. Critical infrastructure can include things like the internet. So how do we possibly capture losses for an entire portion of the internet going down? When you think about the potential cascading effects of that, it's really hard to really capture all of the elements that would be included there. Physical damage is another one. So events that combine physical damage and cyber could have detrimental impacts, such as a widespread blackout caused by a cyber event. But it's really difficult to capture the entire effect of that, which is really the reasoning for the exclusions. And I think this mostly, the main purpose here is that it highlights some areas for potential research. As an industry, if we were able to understand these risks better and try to price for them effectively, there could be an opportunity to innovate and cover more of the things that have been excluded traditionally in cyber policies.
Thank you, Crystal.
Maybe
John,
just
you want to weigh in?
Yeah, I'll add on to a little bit. There was a question in the chat of just how exclusions show up in modeling. I mean, I think the important thing is they should, in the sense that, you know, when doing any kind of analysis in this regard, you know, we think it's important that we should model the way that the policy language actually works. And all of our modeling, and I think that's true for all the companies represented here, starts on a ground up basis. So we're looking at kind of the total cost essentially. And then secondarily, we look at how the policy applies and whether something is excluded or sublimited or things of that nature. That's something that's been really important to us to be able to do. And it allows companies to then understand some of those trade-offs of like, well, maybe if I clawed back this exclusion or I added a sublimit in a particular area, what are the financial trade-offs going to be of that? So that's one important thing. I do want to kind of sound a note of maybe, I'm skeptical but hopeful that maybe some of these exclusions can be pulled back. It's, from my vantage point, it's not primarily a lack of modeling around this. I think it's really, when we think about the premise of how insurance works, it's built around the idea of, you know, a loss might be bad for you, but it doesn't affect your neighbor. And so if you do that in aggregate, what insurers benefit from is diversification and the law of large numbers. And cyber's always kind of occupied, and terrorism too, occupies this kind of funny line that we walk where, you know, the attacks are not purely accidental, right? And so that kind of can cause this diversification point to break down. And so, you know, you can imagine, you know, war is one thing and infrastructure is very related. You know, if there were, you know, an escalation in hostilities, you kind of imagine the critical infrastructure targets of a country might be some of the first things that we're, you know, focused on for disablement to cause societal harm and so forth. And so I think there's a reticence, kind of, even if the modeling got better, I think there's kind of inherent reticence to sort of, you know, protect the things that are maybe first in line if hostilities got much more political. So I think that's an important aspect just to bear in mind as we go along. Now, that said, I think there are some other examples in the insurance world of where we might see some success in this. And rather than something like property, I might point to more how the marine market works, for example, where, you know, there is like, you know, war aviation coverage, for example, or hull war coverage, those kinds of things where different providers come in to take the risk that, you know, kind of the main insurance market may not be willing to take. And so I think as the analytic tools get better, maybe there would be kind of secondary policies people could buy if it was really important to them to plug a particular hole. So it'll be interesting to see how things develop.
All right, thank you. So I'd like to have each of our panelists weigh in on the areas of cyber insurance modeling or underwriting that they believe need additional research. And we'll go ahead and get started with Scott.
Sure, yeah, I mean, there's a lot of areas. I'll just focus on one. It doesn't mean it's the only one we're looking at. But physical damage has become a hot topic for some of our clients recently, both on the insurance side and on the reinsurance side. There are really no good vendor models out there, reliable vendor models out there for physical risk like there are for digital risk. So this is things like have been already mentioned, a power grid failure taking down a bunch of companies, maybe an explosion on an offshore platform that's caused by a cyber attack, a dam getting breached, vehicle hack, which causes an aggregation event across a lot of smart vehicles. There's a lot of things you can imagine. It gets very scary very quickly. You can imagine one of the things we postulated internally is with fracking in the central US. Imagine the fracking facilities get hacked and induce an earthquake. I mean, that sounds way out there, but you can figure out a way to get there if the bad actors really knew what they were doing. So there's a lot of this type of thing where it's scary and there really isn't a good base of modeling for it yet on the physical side.
All right, let's go ahead and have Derek weigh in.
Yeah, I mean, like Scott, there are a lot of areas where research can advance the kind of modeling and understanding of cyber risk. And one area that I think picks up what Scott was saying too is to really understand the full scope of the downstream impacts of a cyber attack, not just the physical, but the other dimensions of it. So if you take something like the Colonial Pipeline cyber attack, really there was an impact to the company itself, but there were all these residual impacts and consequences of the pipeline shutdown. You know, there were fuel shortages and price volatility. And so when it comes to things like infrastructure in particular, you know, how fragile is the system? What are the full scope of impacts if we're talking about, you know, disruption, economic impact, you know, contingent business interruption? I think really understanding those dynamics better would be really good.
All right, thank you. Let's go ahead and have Maurizio again.
Yeah, maybe echoing a little bit what Scott was mentioning earlier, like from the modeling side, when we start talking about really physical damage, we also need to think about the distinction between OT versus IT, the gap between the two, how well protected is an OT versus an IT, how can an IT malware be impacting an OT system, infrastructure system. So those things need for sure better modeling and more research. I would also add one more additional thing, like on the, it was mentioned earlier about the software or digital dependency on certain single point of failures or software, and figuring out how much would your business be impacted by the failure of that software. So it might be that you are using a cloud-based software like Change Healthcare, for example, and the impact that you're seeing downstream, it's a delay of income and not a full loss of income, or it might be just a marginal effect. So how do we establish that? What are the internet dependencies factors that we can rely upon? Is there some confidence in those, some transparency? Is there some common thoughts, like where the industry can come together and agree on that? So these are, I think, other aspects that we need to expand on, I would say.
Thank you. And Crystal.
Yeah, so kind of building off what Maurizio said around BI and CBI, definitely agree. I think Change Healthcare kind of highlighted that the way that we think about BI and CBI maybe needs to just be a little bit more nuanced, because there is delayed income versus loss income, which has a huge difference in insurance recoveries and the amount of loss from an economic standpoint as well. So I think there's a lot more to learn around those topics. And focusing on CBI a bit more specifically, there also, I believe, is more to learn around the cascading impacts. So in insurance wording, sometimes, you know, fourth, fifth, et cetera, party losses are excluded around CBI. So for instance, if a vendor that your vendor uses and your company's impacted by an attack downstream, it may not be covered by insurance, but could still have a lot of economic impact. So I think there's definitely more to explore around both BI and CBI. A couple other areas that I thought of around potential research areas, one is being malware ransomware and how that spreads. So in all of the vendor models, it's pretty widely accepted that malware ransomware is really the tail driving peril in terms of cyber cat risk. But I think there's more to explore around how an automated malware or ransomware would spread to different systems. Is there potential segmentation that could help mitigate that, or other things that could be used to mitigate the spread? So I'd be very interested in research around kind of how those things spread and what could potentially stop it. And then the last one, and I know this is long. I had a long list and narrowed down to 3. But the last one I think is AI, which is obviously is a hot topic in terms of cyber insurance. It's pretty widely accepted that there will be both positive and negative impacts in terms of cyber losses due to AI. So the defense side has more tools using AI, but so does the threat actor side. So I think there's a lot to research around those potential impacts and where that kind of offsetting effect could land in terms of cyber cat risk.
All right, thank you. And finally, John.
Thanks. I'll ditto what everybody else said, but I'll offer one more in kind of a slightly different lane. You probably picked up on the point from some of the prior comments that information is a challenge for the insurance industry. There's a fundamental asymmetry in that organizations know their networks better than the insurers do. That's understood, although oftentimes the organizations don't necessarily understand their networks quantitatively in the way that insurers seek to. Insurers themselves also have data collection challenges, which I think Scott alluded to, in terms of collecting information at scale in a usable way that can be used for this problem solving. But there's kind of a deeper layer that I think sits fundamentally at the core of cyber. And this really deals with the fact that cyber is as much of a sentient peril, we say, as it is, which is the more we know, like if we had perfect information about an organization, yes, it would allow us to, make better calculations about their risk. But, in a sick twist of fate, that is exactly the same kind of information that threat actors themselves would love to use. If they knew exactly how a company's network was segmented, they could figure out the exact, appropriate plan to hose the whole network and, get the actions on objectives that they care about. And so I think one of the things that's maybe not talked about often enough is, are there ways that we can create more secure and protected channels for information sharing between organizations and their insurers and maybe other parties, incident responders and others, so that we can benefit from the same kind of knowledge that would improve the models in the ways that we've been talking about, but that doesn't make us the new target that an organization that threat actors want to compromise in order to use that information toward different ends.
And if I may actually add to what John said, I think part of that is all about reputational risk. People feel like if they report a breach publicly or otherwise, like it's their fault and they're going to have some sort of trouble. We don't have the same issue on the natural catastrophe side. Like if a factory is destroyed by a tornado, it's almost like a badge of honor to rebuild that factory after the tornado and move on. We have like a reputational issue, and there's like a media shaming issue going on with cyber. The media does a great job of shaming companies after a cyber attack. And I think the more we can move away from that, the more companies will be willing to report it, which actually helps everybody, because then we understand why these events happened. We can build better models. We have more data to use. So I think part of it is getting folks to understand that most of these events are not the company's fault. They're almost entirely the bad actor's fault. In some cases, maybe the company didn't have the right controls in place. But I think we need to move away from shaming these companies, and it'll help us get more data.
Yeah,
All right.
That's a good shout.
Thank you. So we did have a few more questions prepared, but in the interest of time, we do want to address at least a couple questions. So we're going to skip over those. Thank you to our panelists for their insights. And I will, let's see, I'll read out a couple questions that we can address before we have to adjourn. All right, so what are the common fields in a data record that you see across public and/or proprietary data sets?
So if this is about cyber incident data, we see the company name, a bit about its firmographics, the revenue and industry. We tend to see the loss information, and depending on where we get the information from, that may be it. Sometimes we get a very short description, a few sentences about the event. Sometimes if the broker knows a lot about what's going on with the client, they'll write a whole file up about it, and it'll be text, it'll be a Word file. So speaking of AI, we've actually used some AI to start to digitize some of those historical claims. But at this point, there's no standardized view of what these fields look like, in my view at least.
All right.
We're trying to get there, by the way. We're trying to come up with a standard, but we're not there across the industry yet.
All right, let's address another question. In many ways, cyber incidents overlap, and in some cases could be looked at as terrorism, or a use of force that could constitute an act of war if tied back to a nation-state actor. Given the difficulty around attribution, is there a way to factor in the uncertainty of if a loss will or will not be classified as war in modeling different CAT events?
I'll start here. This is a juicy question. I think this is one that, candidly, like the organizations that we work for, I think we get very nervous about, maybe kind of taking a stand that like this is war or this isn't war, because, we're not lawyers, and the lawyers that we have probably tell us not to do that. So this probably is an area for some interesting research around what would and would not constitute it. But I think it's worth noting, I mean, it's been a long time since there was an act of war declared in the US. And I think where insurers use covered policy language to continue to innovate and try to better understand how their risks work. And what's been interesting in the market in the last 2 years or so is there's actually been a lot of debate, really led by the reinsurance side, around how policy language should work with respect to war. And it's been less about whether something is actually classified as war or not, because that can get very political. Superstorm Sandy was not a hurricane because we didn't want, hurricane deductibles to come into play, for example, but more just focused on what the impacts are following the event. So is there an escalation in hostilities within 30 days of the incident, for example? You don't have to call it war or not war, but if you see that thing, that starts to give you clues that you can add on to. Where I think we can contribute, and we certainly try to, is to give, our customers, the insurance companies and others using the models. So nation state versus, a financially motivated group versus a hacktivist group versus, something else executing that action. And then you can kind of look at those tools and determine for yourself how you want to define that line or do sensitivity testing around that. So, without giving a hard and fast answer in a place where I think it's really hard to do so, I think what I see us trying to do is equip decision makers to explore those questions for themselves and come to their own conclusions in a more fact-based way.
Thank you.
Yeah.
All right.
And I can echo what John just said.
And Crystal, did you want to weigh in too?
Yeah, I was also going to echo what John said and maybe just re-highlight something he said, that I think this could be a potential research topic. So the attribution part does play into the definitions. There are different versions of the definitions and obviously a lot of debate around that topic. But I think if we were able to attribute events, it may make those a little bit easier. So just wanted to highlight that could be a potential topic that would be beneficial to the industry for this project.
All right. Let's see. How do cyber modelers take into account or improve output based on changes or improvements in policy languages?
I can take a quick stab at it. We do, on an ongoing basis, change some of our modeling assumptions or algorithms. This is more focused on the financial module of our model, let's say. So we have geographical specific settings for where certain policies coverages might be excluded. If things change, we can adapt those. We are currently, for example, implementing new war language definitions from Lloyd's. So we allow customers to specify which type of language, policy language they're using. And then based on that, we assign a certain likelihood of that language being able to exclude certain events, for example. So, and there are many other examples, but all this to say that it's a, and I'm sure other model vendors can say the same. We are in a, the stuff that we are modeling can be really adapted to these type of changes, especially if it's on the financial side.
Yeah, I would add to that briefly that I think that I agree overall. One thing is making sure that events are defined robustly so that they can respond to the language, but also having flexibility in how the insurance terms and conditions are captured, recognizing that the market is very dynamic in terms of the various cyber insurance products that are available. And so having sufficient flexibility in how you code limits and deductibles and other terms is important. So we've definitely made sure that we're investing in that. I think all the modelers have.
Yeah, and the only thing I would add to that, as someone who uses the tools of the vendors that are on the panel here, I think the biggest thing from that side of things is understanding each vendor and the inputs and outputs. So there are times where we exclude specific events or specific coverage parts based on nuanced wording. And I think it really just comes down to understanding the model and how to modify inputs and outputs to match the custom policy wording of the insured best.
Okay, I think we have time for another question. In order for academics to help examine the relationship, hang on, let me pull it back up. Okay, in order for academics to help examine the relationship between precautions, type of infrastructure, vulnerabilities, firm characteristics, and cyber incidents, we need data from the insurance industry. Is this possible?
So I can start with that, because we have done some academic collaborations. But from a compliance and legal perspective, it's not easy to the extent where any student that's working with us has to actually become an employee of us. They literally have to be a member of my team, like literally an intern on my team. That's the only way that we can do it. Like we can't even sign NDAs are not sufficient. The only way is if they're literally an employee on the team, which is possible, but not easy. So if people are really motivated, now they're gonna all email me, which is fine. But if people are really motivated to do this, they'd have to propose something that's very exciting to our management, to my team, to all these folks, and then we could talk about it and see what makes sense. I will say it's possible, but very difficult.
I would say the attitude in the industry has been shifting a bit on this topic, and I think one of the points to maybe probe in as a follow-up on the question is what kind of data specifically. Building on what Scott said, attorney-client privilege protects a certain amount of the information, but if that's if you want things that are attributable to organizations. But there's been, I think in the past, cyber insurers treated their data as extremely proprietary. They were the ones taking the risk to build their data sets. That's been changing in recent years. Cyber AccuView is a good example of an industry, data collection organization where carriers have recognized it is in their best interest to share certain information with each other. And these systemic or catastrophic issues are of concern to everybody. So I think I would say the double click on, or the addendum to what Scott said is, I think care needs to be taken in terms of what kind of data specifically you're looking for. And are there ways that we can do that kind of protects confidentiality where it's needed, but helps further the research in areas where it's going to benefit everybody.
Thanks, John. I think we have time for one more question. For non-war, catastrophic, or widespread event, should there be an industry standard or government involvement in declaring a catastrophic cyber event? How do insurers define it currently, especially the ones that sublimit such losses?
Well, I think catastrophic cyber is, I guess that varies depending on one's perspective, and companies will manage to a level of risk that they're comfortable with, whether that's from a single event or, in the aggregate, manage their accumulations accordingly. So they don't necessarily have to define what constitutes catastrophic in terms of any sort of policy language. Maybe it becomes a little bit more ingrained when you look at kind of industry event reporting, like a PCS style reporting of cyber losses, or ILS that is based on some measure of industry loss threshold. But I don't think it's necessary to actually define what a level of catastrophic loss is. Just my personal opinion.
Anyone else want to weigh in?
Yeah, I would agree with that. I think the definition may vary slightly based on what it's being used for. So if you're aggregating losses in an event to go through like a reinsurance structure, it would depend on that wording, which kind of, as I mentioned earlier, often uses that like automated definition. and same with ILS structures. So in those cases, the wording has an impact there, but I don't necessarily think it would make a lot of impact to declare something as catastrophe or not catastrophe just in general. I think it's more specific to the reasoning behind declaring it or not.
Yeah, I would just say as a general comment, there's a high level of ambiguity with cyber, and I think there's a natural instinct that many of us have to try to get rid of that ambiguity. I think we just need to recognize it's there, and it's going to continue to be there in different forms. Where we can reduce uncertainty, we should certainly aspire to, but I think we're better off kind of recognizing that ambiguity is kind of naturally part of a system that's as fluid as technology risk is, and kind of planning our strategies with that recognition in mind, rather than kind of wishing it away.
All right, thank you. I think we could talk about this for several more hours, but we do have to stop now. Thank you so much to our panelists for the excellent discussion. As you saw, their contact information is in the slide deck, which you can download, as well as some resources. And then, of course, if you have questions about the IUCRC, please contact Mohan or me, and we'd be happy to talk it over with you. So with that, thank you everyone so much for your participation.
Thanks.
Thank you.
Thank you.